If you're running a business, there's a chance you might be paying 20% more taxes than you actually need to. That could mean you could be paying thousands of dollars in taxes that you don't actually need to pay. When structuring a business, there are two most common structures, and these are a sole trader or a company. There are other structures, obviously, but today we'll be focusing on these two. We're going back to the basics. Okay, so it might sound obvious, but a sole trader is, well, a sole trader. You'll set up an ABN, also known as Australian Business Number, and that ABN is still linked to your personal tax file number, also known as TFN. Because of this, your business activities are taxed under your personal tax return as well. As a result, the amount you tax is the same as any ordinary individual employee. You can find these rates on the Australian government website, and it ranges from 0% all the way up to 45% depending on how much money you make. Sole traders generally do the work themselves, but sometimes they may outsource to other contractors or hire employees, and it all depends on the industry you're working in. Common examples of sole traders are freelancers, plumbers, consultants, or even e-commerce businesses. It's simple, setup is minimal, it's just one simple tax return, and sometimes if you're registered for GST, you will need to lodge business activity statements per quarter. You don't really need to worry about drawing money out, or pleasing shareholders, or staying on top of all your super and all those complicated business stuff. But income isn't the only thing that's linked to your personal name. As a sole trader, everything is. So if your business goes into debt, you go into debt. Your personal assets are liable and you have no protection if hits the fan. Okay, but let's say the business is actually doing really well. So well, in fact, that you're making over $300,000 in profit every year. You're being taxed at over 45% in taxes. That's almost half of every dollar you make after $190,000 that's being taxed. Sure, the money you use to reinvest into your business is tax deductible, but you still need cash to use it. This is where a company comes in. Before even defining a company, let me skip to the good stuff. Your typical company has a flat tax rate of 25%. That's 20% less than what an individual can be taxed at, which is 45%. But what is a company? Just so you get the proper definition, I'm going to quote the Australian government website. A company is the type of business structure where your business forms separate legal entity. This means that the company has similar rights as a natural person and can incur debt, sue, or be sued. In general, companies can be expensive and complicated to set up, but they suit people who expect their income to be variable or they're making shit tons of money. Firstly, on being a separate legal entity, let's say, for example, your business falls into debt and then it gets sued. The suer can go after the sole trader's personal assets since the business is tied to them directly. But for a company, they can only go after the company's assets. Let's say you own a coffee shop, for example, and decide to expand. You borrow money for new equipment and renovations, but the business decides to not do so well and it slows down. You can't repay the loan. As a sole trader, the bank can come after your personal savings, your assets, your house, even your car, because your personal and business assets are connected. Now let's look at the same situation if the coffee shop was set up in a company instead. The business still owes the money, but the bank can only go after the company's assets, which is the equipment, the inventory, and any cash in the business account. Your personal savings, house, and personal car are safe because they're separate from the company's assets or finances. Unless you may have signed a personal guarantee on the loan, then it gets a bit complicated, so it's best to speak to some expert to kind of work that out. As an owner of the company, your only financial obligation is to pay the company any amount for the shares that you were entitled to. Keep in mind, the directors of the company may still be held personally liable if they're found to be breaching any legal obligations as a director. All right, so you're not fully protected with a company, but at least it creates some sort of protection when it comes to running your business. Also, because a company is a separate legal entity, so is its money. Yes, you founded and control the company, but that money isn't actually yours, it's the company's. You're not allowed to use the company's money on whatever you want. You need to draw that money out to yourself, either in the form of wages or a dividend. And I know, sure, this is a bit annoying since technically your taxes end up being the same as the personal tax brackets, but you're probably going to reinvest that money into the business anyway, so wouldn't it be easier just to keep it in there and enjoy that 25% tax bracket? Now, with most businesses, you're generally ready to start with some sort of money. You have everything lined up, an idea, the people, the time. You're ready to build an unstoppable empire. You're just missing the money and the capital. That's where shareholders come in. Companies can introduce shareholders to raise capital. Get like-minded people who are investors on board and believe in your vision to help you get started. If you're a sole trader, good luck trying to get people on board by just going, come on man, I got the best business idea, trust me, give me $100,000 and I got this. I haven't done it before, but I just know 100% that this is gonna work. Trust me, just trust me. I just need $100,000, please. It doesn't work as a sole trader, which leads on to another point. Companies given an image of legitimacy. Potential customers and other businesses often aren't too keen to deal with sole traders. So this unlocks a lot more opportunities for growth and expansion. Okay, I could go on and on about the features and rulings of a company, but those are the main key things. It might sound like a company is the way to go 100% of the time, but it doesn't actually suit everyone. There are a few reasons for this. First, there needs to be a good reason for you to be using a company structure. There's a ruling called personal services income, which could strip away all your tax minimization benefits. It's really complicated, and we've actually made a video about it here. Number two, even if you do fulfill the requirements, setting up a company still takes time and money. There are quite a few other things I haven't even mentioned, like getting a director ID number. Maybe your business is simple and minimal, and you might not actually gain much from creating a company. And sometimes that is true. Maybe it's something for later on down the track. It's best to speak to a professional accountant like me. So this video did get into a bit more detail than I was expecting when I was writing this. So let's just summarize it all. Here are the advantages of a sole trader. It's cheap to set up and maintain. Taxes are a lot easier to do with one tax return required. No super contributions required on the money you take out. No workers' compensation required if you don't have the staff. Overall, just simple and easy. But there are disadvantages of a sole trader. Taxes are high if you're making too much money. You're personally liable for all the business debts. Less flexibility in future tax planning. If you die, so does your business. Literally. I didn't mention it before, but yeah, that's a thing. Here are the advantages of a company. Your personal assets are being protected from any losses incurred by the company. There's increased flexibility for tax planning for companies, and you can introduce shareholders, equity, and raise capital for the company. Income can also be split to reduce tax liabilities. Make sure you see an accountant about this though. And your business gets another layer of legitimacy by being a company. Here are the disadvantages of a company. There are high costs to maintain and establish. It's more time consuming and you need to lodge multiple tax returns, at least one for yourself, one for the company, and winding up the business can be costly and slow. So which one's for you? Well, it's up to you. What suits your needs the most? If you're not sure, again, see an accountant like me and they can break it down for you. Otherwise, if you have any other questions, leave them in the comments below. And don't forget to like this video, subscribe to the channel, and I'll see you next time.